Question 1. Which of the following annuity types is characterized by its potential for higher returns based on the performance of a selected market index, but also includes caps, floors, and participation rates to limit both growth and loss? A. Fixed annuity. B. Variable annuity. C. Indexed annuity. D. Immediate annuity. Answer: C. Indexed annuity. Explanation: indexed annuities are a type of fixed annuity that are linked to the performance of a market index, such as the S&P 500. They provide a potential for higher returns than traditional fixed annuities, but with caps, upper limits on gains, floors, minimum guarantees, and participation rates, a percentage of the index's return. This structure allows the annuity to benefit from positive market performance while providing some protection against losses, unlike variable annuities, which can expose the annuitant to market risk without such safeguards. Question 2. Mr. Thompson, a 60-year-old retiree, is interested in an annuity that provides guaranteed income for life, with the option for his beneficiaries to receive a death benefit. He wants to ensure that his payout amount is fixed and will not fluctuate. Which annuity product should he choose? A. Fixed immediate annuity with a death benefit rider. B. Variable annuity with a living benefits rider. C. Fixed deferred annuity. D. Single premium immediate annuity SPIA. Answer: A. Fixed immediate annuity with a death benefit rider. Explanation: a fixed immediate annuity SPIA provides guaranteed income for life, which aligns with Mr. Thompson's desire for a stable payout amount. The addition of a death benefit rider ensures that his beneficiaries will receive a benefit if he passes away. This makes it a suitable option as it guarantees both lifetime income and a death benefit. In contrast, variable annuities have market risk, and fixed deferred annuities delay payouts, which does not meet Mr. Thompson's need for immediate income. Question 3. Which of the following is a primary consideration when determining the suitability of an annuity for a client under Massachusetts suitability standards? A. The client's credit score. B. The client's risk tolerance and investment objectives. C. The client's age and life expectancy. D. The annuity's historical performance. Answer: B. The client's risk tolerance and investment objectives. Explanation: under Massachusetts suitability standards, the producer must assess a client's risk tolerance and investment objectives before recommending an annuity. These factors help ensure that the annuity aligns with the client's financial goals, whether for retirement income, estate planning, or other objectives. Age and life expectancy may also play a role in product suitability, but the primary focus is on how the product fits the client's broader financial needs, not just their personal characteristics or product past performance. Question 4. Which of the following is true regarding the tax treatment of annuity distributions under the Internal Revenue Code? A. Annuity distributions are taxed as capital gains. B. Tax-deferred annuity growth is taxed as ordinary income when distributed. C. Annuity distributions are tax-free if the contract is held for at least 10 years. D. Annuity distributions are exempt from tax if the annuitant is over 591 years old. Answer: B. Tax-deferred annuity growth is taxed as ordinary income when distributed. Explanation: annuities grow on a tax-deferred basis, meaning that taxes on earnings are not owed until distributions are made. When distributions are taken, the earnings are taxed as ordinary income rather than at the lower capital gains tax rate. This tax treatment applies unless the annuity is held in a qualified retirement plan, in which case additional rules may apply. The other options are incorrect, as annuity distributions are not taxed as capital gains, do not become tax-free after 10 years, and are not exempt based on the annuitant's age alone. Question 5. Annuities can be used for various financial planning purposes. Which of the following is not a common purpose for using an annuity? A. Providing guaranteed income for retirement. B. Protecting against longevity risk by ensuring lifetime income. C. Minimizing tax exposure through tax-free withdrawals. D. Using tax-deferred growth to accumulate funds for future use. Answer: C. Minimizing tax exposure through tax-free withdrawals. Explanation: annuities offer tax-deferred growth, meaning earnings on premiums are not taxed until withdrawn, but they do not offer tax-free withdrawals. When withdrawals are made, the earnings portion is subject to ordinary income tax. Annuities are primarily used for providing guaranteed income, especially in retirement, mitigating longevity risk by ensuring income for life and growing funds on a tax-deferred basis. The idea of minimizing tax exposure through tax-free withdrawals is not applicable to annuities. Question 6. Which of the following is the primary purpose of a guaranteed minimum income benefit (GMIB) rider in a variable Annuity A. To guarantee a minimum death benefit for the annuitant's beneficiaries. B. To ensure that the annuitant's income will never decrease below a certain level. C. To provide a fixed return on premiums invested in the annuity's subaccounts. D. To guarantee that the annuitant's investment in the annuity will grow at a fixed rate. Answer: B. To ensure that the annuitant's income will never decrease below a certain level. Explanation: a guaranteed minimum income benefit (GMIB) rider is attached to a variable annuity to ensure that the annuitant will receive a minimum level of income regardless of the performance of the underlying investments. The GMIB typically provides a baseline income regardless of the annuity's investment performance, giving the annuitant security in knowing that their income will not drop below this minimum level. This is distinct from a death benefit or fixed return, as it focuses on income protection rather than growth or beneficiary protection. Question 7. Mr. Harris, 68 years old, is seeking an annuity product that provides guaranteed income for life, and he is also concerned about protecting his heirs in the event of his death. He is particularly interested in minimizing risk while still ensuring that his beneficiaries will receive some benefit. Which option would be best for Mr. Harris? A. Immediate fixed annuity with a lump sum death benefit. B. Single premium immediate annuity SPIA with a refund option. C. Variable annuity with guaranteed minimum death benefit GAB rider. D. Fixed annuity with a return of premium rider. Answer: B. Single premium immediate annuity SPIA with a refund option. Explanation: a single premium immediate annuity SPIA with a refund option provides guaranteed income for life, with the added benefit that if the annuitant dies before receiving an amount equal to or greater than the initial premium, the remaining balance is refunded to the beneficiaries. This product fits Mr. Harris' need for guaranteed lifetime income and protection for his heirs. A variable annuity with a GMDB rider provides a death benefit but does not offer guaranteed income. The return of premium rider on a fixed annuity provides some death benefit protection but does not guarantee income for life. Question 8. Which of the following best describes the impact of inflation on annuity payouts? A. Annuity payouts are automatically adjusted to keep pace with inflation unless the contract specifies otherwise. B. Annuity payouts typically decrease over time due to inflation unless the annuity includes an inflation rider. C. Inflation has no effect on annuity payouts because they are fixed for life. D. Annuity payouts are designed to increase annually by a fixed percentage to match inflation. Answer: B. Annuity payouts typically decrease over time due to inflation unless the annuity includes an inflation rider. Explanation: annuity payouts are generally fixed for the duration of the contract unless an inflation rider is included. Without this rider, payouts do not adjust for inflation and may lose purchasing power over time. An inflation rider can increase payouts over time to keep pace with inflation, but it is not automatically included in most annuities. Option C is incorrect, as inflation can erode the value of fixed payouts, and D would be applicable only if an inflation rider is in place, which is not the default for all annuities. Question 9. Which of the following statements about the taxation of death benefits from an annuity is true? A. The death benefit from a non-qualified annuity is paid out tax-free to the beneficiary. B. The death benefit is always taxed as ordinary income regardless of whether the beneficiary is a spouse or non-spouse. C. The beneficiary of a non-qualified annuity can receive the death benefit as a lump sum without any tax obligations. D. The death benefit from an annuity is not subject to taxes if the annuitant dies before reaching the age of 591. Answer: B. The death benefit is always taxed as ordinary income regardless of whether the beneficiary is a spouse or non-spouse. Explanation: the death benefit from an annuity is generally subject to ordinary income tax based on the earnings in the annuity. The beneficiary will owe taxes on the earnings portion of the death benefit whether the beneficiary is a spouse or non-spouse. There are no specific exceptions for taxes based on the annuitant's age, and tax-free payouts are not typical for non-qualified annuities. Non-qualified annuities do not offer tax-free death benefits, and the earnings portion of the death benefit is taxable. Question 10. Which of the following best describes the surrender charge in an annuity contract? A. A fee imposed when the annuitant transfers their annuity to another provider. B. A penalty imposed if the annuitant surrenders the annuity within a specified period. C. A one-time fee paid at the time the annuity is purchased. D. A tax imposed by the IRS for early withdrawals from an annuity. Answer: B. A penalty imposed if the annuitant surrenders the annuity within a specified period. Explanation: A surrender charge is a fee charged by the insurer when the annuitant withdraws funds or cancels the annuity within a specified surrender period, typically during the first few years of the contract. This charge is designed to discourage early withdrawals and compensate the insurer for the costs associated with issuing the annuity. The surrender charge does not apply to transfers to other providers, option A, or to taxes, option D, and it is not a one-time purchase fee, option C. Question 11. Which of the following statements about a fixed indexed annuity is correct? A. The interest credited to the annuity is based solely on the performance of a stock market index. B. The interest credited to the annuity is guaranteed to be at least 0% annually, regardless of market conditions. C. Fixed indexed annuities provide an income that is variable and dependent on market performance. D. The premium payments in a fixed indexed annuity are invested directly in the stock market. Answer B. The interest credited to the annuity is guaranteed to be at least 0% annually, regardless of market conditions. Explanation. Fixed indexed annuities offer a return based on the performance of a market index, but they also guarantee a minimum return, often 0%. This means that even if the index performs poorly, the annuity will not lose value. Option A is incorrect because the index performance is used to calculate the interest, but the return is not directly based on the index itself. Option C is incorrect as FIAs provide a fixed return with potential for higher gains based on market performance, but they do not offer a variable payout. Option D is incorrect because premiums are not directly invested in the stock market but are linked to an index. Question 12. Which type of annuity provides immediate payments that begin within 1 year of purchase? A. Deferred fixed annuity. B. Immediate fixed annuity. C. Variable annuity. D. Fixed indexed annuity. Answer B. Immediate fixed annuity. Explanation. An immediate fixed annuity begins paying out income almost immediately, typically within 1 year of purchase. It is often used by individuals who are seeking guaranteed income right away. A deferred fixed annuity, on the other hand, does not begin payouts until a later date, while variable and fixed indexed annuities may have different payment structures that are linked to investment performance or market indices. Question 13. Which of the following features is typically found in a long-term care rider attached to an annuity? A. It provides a guaranteed income for life. B. It allows the annuitant to access funds for long-term care expenses without penalties. C. It provides a death benefit that exceeds the value of the annuity. D. It offers tax-free withdrawals for healthcare costs. Answer B. It allows the annuitant to access funds for long-term care expenses without penalties. Explanation. A long-term care rider allows an annuitant to access the annuity's value to pay for long-term care expenses, typically without incurring surrender charges or penalties. This rider is designed to help cover the costs of care in the event that the annuitant needs assistance with activities of daily living. Options A and C are incorrect as they refer to other features, and D is incorrect because withdrawals for healthcare costs are generally not tax-free unless certain conditions are met, such as if the annuity is held within a qualified plan. Question 14. Which of the following best describes a longevity annuity? A. An annuity that provides income immediately for a fixed term. B. An annuity that starts providing income only after a certain age, often 80 or 85. C. An annuity that pays out a lump sum after a specified number of years. D. An annuity that provides a fixed payout amount each month, regardless of the annuitant's age. Answer B. An annuity that starts providing income only after a certain age, often 80 or 85. Explanation. A longevity annuity, also known as a deferred income annuity, is designed to start providing income later in life, typically after the annuitant reaches an advanced age, e.g., 80 or 85. This type of annuity is often used to provide financial security in later years, particularly for individuals concerned about outliving their retirement savings. Option A describes a traditional annuity. Option C describes a different type of annuity structure, and option D does not capture the deferred nature of a longevity annuity. Question 15. Which of the following is a characteristic of a structured settlement annuity? A. The annuitant can access lump sum payments at any time. B. Payments are typically made in periodic installments over time, often following a lawsuit or legal settlement. C. The annuity guarantees a higher than market interest rate for the life of the annuity. D. Structured settlements are primarily used for providing an income stream during retirement. Answer B. Payments are typically made in periodic installments over time, often following a lawsuit or legal settlement. Explanation: structured settlement annuities are often used to provide periodic payments to individuals who have received a settlement from a lawsuit, such as for personal injury claims. The payments are made over time and can last for many years. They provide a steady income stream to the recipient. Options A and C are incorrect, as structured settlements involve scheduled payments rather than lump sums or guaranteed high interest rates. Option D is incorrect, because structured settlements are typically used for settlements, not for retirement planning. Question 16. Which of the following would be considered a disadvantage of a variable annuity? A. Guaranteed minimum interest rates. B. Investment risk tied to the performance of underlying assets. C. Tax deferral on earnings. D. The ability to make tax-free withdrawals. Answer: B. Investment risk tied to the performance of underlying assets. Explanation: variable annuities expose the annuitant to investment risk because the value of the annuity is linked to the performance of the underlying sub-accounts, which may include stocks, bonds, or mutual funds. While this provides the potential for higher returns, it also comes with the risk of loss. Option A is incorrect, because variable annuities do not guarantee minimum interest rates like fixed annuities. Option C is true of variable annuities, but it is not a disadvantage. Option D is incorrect, because withdrawals from variable annuities are generally taxable. Question 17. A 55-year-old individual wants to withdraw funds from his deferred annuity. What is the likely tax implication of withdrawing funds before reaching age 591? Well, A. The withdrawal is penalty-free and taxed as ordinary income. B. The withdrawal is taxed as a capital gain. C. The withdrawal is subject to an additional 10% penalty tax in addition to ordinary income tax. D. The withdrawal is subject to a 5% penalty tax. Answer: C. The withdrawal is subject to an additional 10% penalty tax in addition to ordinary income tax. Explanation: withdrawals from annuities before age 591 were generally subject to a 10% early withdrawal penalty in addition to being taxed as ordinary income. This penalty is imposed to discourage early access to retirement funds. Option A is incorrect, because it omits the early withdrawal penalty. Option B is incorrect, as annuity withdrawals are taxed as ordinary income, not capital gains. Option D is incorrect, as the penalty is 10%, not 5%. Question 18. Which of the following types of annuities provides payouts that are linked to the performance of underlying investments but still offer a guarantee against loss of principal? A. Fixed annuity. B. Variable annuity with a guaranteed minimum income benefit, GMIB. C. Fixed indexed annuity. D. Immediate annuity. Answer: C. Fixed indexed annuity. Explanation: a fixed indexed annuity provides returns linked to a market index but offers protection against loss of principal. This means that even if the market index performs poorly, the annuity will not lose value and the principal is guaranteed. Option A is incorrect, because a fixed annuity provides a guaranteed return but is not linked to market performance. Option B describes a variable annuity, but the GMIB only guarantees income, not principal protection. Option D provides guaranteed income but does not offer market-linked growth. Question 19. What is the free look period in an annuity contract? A. A period during which the annuitant can cancel the annuity contract for a full refund. B. The period during which an annuity must be held before withdrawals can be made. C. A cooling-off period during which the annuitant can review the annuity contract and withdraw without any penalties. D. A period in which the annuitant can transfer the annuity to another company without any fees. Answer A. A period during which the annuitant can cancel the annuity contract for a full refund. Explanation: the free look period is a specified time frame, typically 10 to 30 days after the annuity contract is issued, during which the annuitant can review the contract and cancel it for a full refund of any premium paid. This allows the annuitant to reconsider their purchase decision. Option B is incorrect, because there is no standard waiting period before withdrawals. Option C is incorrect, because the free look period only allows cancellation, not tax-free withdrawals. Option D is incorrect, as transfers typically incur fees or charges. Question 20. Which of the following best defines a qualified annuity? A. An annuity purchased using after-tax dollars. B. An annuity purchased with pre-tax dollars, typically within a qualified retirement plan. C. An annuity that provides guaranteed income for a fixed number of years. D. An annuity that does not allow for tax deferral. Answer: B. An annuity purchased with pre-tax dollars, typically within a qualified retirement plan. Explanation. A qualified annuity refers to an annuity purchased within a qualified retirement plan such as an IRA or a 401k using pre-tax dollars. This allows the annuity to grow tax-deferred until distributions are taken. In contrast, Option A refers to a non-qualified annuity which is purchased with after-tax dollars. Option C is incorrect because it describes a characteristic of some annuities, but not necessarily qualified ones. Option D is incorrect because qualified annuities do allow tax deferral. Question 21. Which of the following best describes a deferred annuity? A. An annuity that begins payments immediately after purchase. B. An annuity where the payment begins at a future date, allowing for the accumulation of interest. C. An annuity with payments that start immediately and continue for a fixed period. D. An annuity with payments that start after a set period but provide no tax deferral. Answer B. An annuity where the payment begins at a future date, allowing for the accumulation of interest. Explanation. A deferred annuity is one where the annuity payments begin at a future date, typically years after the initial purchase. During the accumulation phase, funds grow on a tax-deferred basis. Option A describes an immediate annuity. Option C describes an immediate annuity with a fixed period, and option D is incorrect because deferred annuities provide tax deferral. Question 22. In Massachusetts, which of the following is true regarding the suitability standard for annuity transactions? A. An agent must prioritize their own financial goals over the client's needs. B. The agent must only consider the client's financial status, not their risk tolerance. C. The agent is required to act in the best interest of the client, considering financial goals and risk tolerance. D. There are no specific suitability standards for annuity sales in Massachusetts. Answer. C. The agent is required to act in the best interest of the client, considering financial goals and risk tolerance. Explanation. In Massachusetts, agents must adhere to the suitability standard, meaning they must act in the best interest of their clients, taking into account factors such as financial goals, risk tolerance, age, and other personal circumstances. This is a key element of consumer protection and is part of the state's consumer protection laws in annuity sales. Option A is incorrect because it misrepresents the agent's responsibilities. Option B overlooks the broader considerations required under the suitability rule, and option D is incorrect as there are specific suitability standards for annuity sales in Massachusetts. Question 23. Which of the following statements about variable annuities is true? A. The premiums paid into a variable annuity are guaranteed to grow at a fixed rate. B. The value of the annuity depends on the performance of underlying investments, typically mutual funds. C. The annuitant is guaranteed to receive the same payout regardless of market conditions. D. Variable annuities are typically tax exempt when purchased through qualified plans. Answer. B. The value of the annuity depends on the performance of underlying investments, typically mutual funds. Explanation. Variable annuities allow the owner to allocate premiums to a variety of investments, such as mutual funds. The value of the annuity fluctuates based on the performance of these investments, which means the payout could vary. Option A is incorrect because variable annuities do not guarantee a fixed return. Option C is incorrect because payouts are not guaranteed to remain the same and depend on market performance. Option D is incorrect because while variable annuities purchased through qualified plans do offer tax deferral, they are not tax exempt. Question 24. Which of the following is a benefit of using a guaranteed minimum income benefit GMIB rider with an annuity? A. It allows the policyholder to take a lump sum distribution immediately. B. It provides guaranteed income for a set number of years, regardless of market conditions. C. It offers a death benefit equal to the premium paid into the annuity. D. It guarantees that the annuity will grow at a fixed rate over time. Answer. B. It provides guaranteed income for a set number of years, regardless of market conditions. Explanation. A GMIB rider guarantees a minimum level of income regardless of the performance of the underlying investment for a set number of years. This makes it a valuable tool for individuals seeking predictable income streams. Option A is incorrect because GMIB riders do not provide lump sum distributions, but rather guarantee income over time. Option C is incorrect because it describes a death benefit, not a GMIB rider's primary function. Option D is incorrect because GMIB does not guarantee growth at a fixed rate, only income. Question 25. Mr. Thompson is 68 years old and is considering purchasing an annuity to supplement his retirement income. Which type of annuity would be most appropriate if Mr. Thompson wants to start receiving payments immediately after purchase? A. Deferred annuity. B. Fixed annuity. C. Immediate annuity. D. Variable annuity. Answer C. Immediate annuity. Explanation. An immediate annuity starts payments immediately after the purchase. This is ideal for someone like Mr. Thompson, who is already in retirement and needs income right away. Option A is incorrect because the deferred annuity begins payments at a later date. Option B and D are both types of annuities that could be immediate, but the key distinction is that the immediate annuity focuses on starting payments right away, which is what Mr. Thompson is looking for. Question 26. Which of the following is true regarding the taxation of annuities in Massachusetts? A. Annuity payouts are taxed as capital gains regardless of whether they are qualified or non-qualified. B. Interest earned on an annuity is subject to ordinary income tax rates when withdrawn. C. Qualified annuities are tax exempt during the accumulation phase. D. Annuities are not subject to state income tax in Massachusetts. Answer B. Interest earned on an annuity is subject to ordinary income tax rates when withdrawn. Explanation. The interest earned on both qualified and non-qualified annuities is taxed as ordinary income when withdrawn. Option A is incorrect because annuity payouts are taxed as ordinary income, not capital gains. Option C is incorrect because qualified annuities are tax deferred, not tax exempt. Option D is incorrect because Massachusetts does tax annuities under state income tax law. Question 27. Which of the following is true about the surrender charge in an annuity contract? A. The surrender charge is the amount the insurer charges for early withdrawals within the contract surrender period. B. Surrender charges apply only to immediate annuities and not to deferred annuities. C. Surrender charges are a form of penalty only if the annuitant exceeds the allowable withdrawal amount during the income phase. D. The surrender charge is typically a one-time fee that applies to the entire contract period. Answer A. The surrender charge is the amount the insurer charges for early withdrawals within the contract surrender period. Explanation. Surrender charges are fees applied to early withdrawals made during the surrender period, typically in the early years of the annuity contract. This charge is designed to discourage the early cancellation of the contract. Option B is incorrect because surrender charges can apply to both immediate and deferred annuities depending on the contract. Option C is incorrect because the charge applies to early withdrawals, not just withdrawals exceeding a limit during the income phase. Option D is incorrect because surrender charges typically decrease over time and are not a flat fee. Question 28. Which of the following is a key characteristic of a fixed indexed annuity? A. The return is based on a fixed interest rate set by the insurer. B. The return is based on the performance of a stock market index, such as the S&P 500. C. The return is guaranteed and does not depend on any external factors. D. It offers unlimited growth potential without any caps or participation rates. Answer B. The return is based on the performance of a stock market index, such as the S&P 500. Explanation. A fixed indexed annuity offers returns based on the performance of a stock market index, typically with caps, floors, and participation rates that limit the potential for growth. Option A is incorrect because it refers to a fixed annuity, not an indexed annuity. Option C is incorrect because FIAs are not guaranteed to earn a fixed return. Option D is incorrect because FIAs are subject to caps and participation rates limiting growth potential. Question 29. Which of the following best describes a 1035 exchange? A. A tax-free exchange of one annuity contract for another without triggering tax consequences. B. A taxable event where an annuity is converted into a qualified plan. C. A process by which an annuity is sold to a third party for a lump sum payment. D. A provision that allows annuity owners to withdraw their funds without penalty before the age of 591. Answer A. A tax-free exchange of one annuity contract for another without triggering tax consequences. Explanation. A 1035 exchange allows an individual to exchange one annuity contract for another without triggering immediate tax consequences. This allows policyholders to switch annuities while maintaining the tax-deferred status of their funds. Option B is incorrect because a 1035 exchange does not involve converting an annuity to a qualified plan. Option C describes a structured settlement, and option D refers to the early withdrawal rules, not a 1035 exchange. Question 30. Which of the following is true about the role of the producer in annuity sales in Massachusetts? A. The producer is responsible for ensuring that the annuity meets the suitability requirements based on the client's financial profile. B. The producer is not responsible for providing clients with full disclosures about the annuity's fees and charges. C. The producer is allowed to recommend annuities that are not suitable for the client's financial needs as long as the client agrees. D. The producer must prioritize the insurer's needs over the client's financial objectives when making recommendations. Answer A. The producer is responsible for ensuring that the annuity meets the suitability requirements based on the client's financial profile. Explanation. In Massachusetts, producers are required to adhere to the suitability standards in annuity transactions. This means they must recommend products that align with the client's financial goals, risk tolerance, and other personal factors. The producer is obligated to provide full disclosures about the annuity, including fees and charges, making option B incorrect, and must act in the best interest of the client, not prioritizing the insurer's needs, making option D incorrect. Option C is also incorrect because producers must recommend products that meet the suitability requirements for the client, regardless of client consent.